Thank you for joining us for this month's Vertical IQ Industry Focus, where we look in detail at various sectors of the national economy, highlighting those industries that are doing well and those where the reality is less bright. Industry Focus is presented by Vertical IQ's chief economist, Ingo Winzer. Ingo was the founder of Local Market Monitor, is a graduate of MIT and Boston University, and he's not your typical economist. He presents data from a very practical business perspective and doesn't mind avoiding cautious conclusions. So without further ado, I'll turn it over to Ingo.
Thank you very much, Julie. Every month we look at industries in a specific sector of the U.S. economy, how they're doing, how they may be affected by current developments, and what that means for the future. Our focus this month is on the financial sector, which provides just 6% of all jobs in the economy, but has an outsized effect. It's made up of companies that are involved in banking, which these days is mainly money transactions and credit cards, portfolio management, which is investment funds and investment advice, insurance, mainly life, property, and health insurance, real estate, which is the renting out of office space, apartments, and homes, and the leasing of cars, trucks, and machinery used for construction, mining, commerce, and manufacturing. All of these activities are strongly affected by interest rates and by the amount of risk financial companies are willing to accept in order to get the returns they need. The value of the assets held by financial companies is also an important issue. And all financial companies are affected by the biggest risk of all, which is the strength or weakness of the U.S. economy. So we'll look now at some of these risks, and we'll also look at possible job eliminations due to the use of more artificial intelligence. Here we see a quick history of interest rates since 2021, as shown by the 30-year mortgage rate. These jumped in 2023 and have stayed between 6 and 7%. For financial companies, higher interest rates usually means higher risks. Among the major holdings of financial companies are mortgages and mortgage-backed securities. As a result of the bubble in home prices before interest rates rose, homes now cost 60% more and are 20% higher than incomes can support. This suggests that a large part of the assets held by financial companies are overvalued. Here we see that home prices in Texas, one of the strongest real estate markets in the country, have been virtually flat for the last few years. At best, this could mean the value of homes and mortgages will steadily be eroded by inflation. At worst, it means a sharper drop in asset value as home prices fall. Credit cards are a major source of income for many banks. Following a dip during the COVID recession, the rate at which banks are writing off bad credit card debt and holding more delinquent accounts is the highest since the 2008 recession. The best way to measure the strength of the U.S. economy is to look at the rate at which it's creating jobs. Jobs are consumers, and consumers are the economy, especially for the financial sector. This chart shows the percent increase in jobs every month compared to the same month of the previous year. And it shows that job growth has been slowing during the last few years and is now close to zero. To a large extent, this reflects the growth of the U.S. population, which last year was just 0.5%, and this year also will be very close to zero. A stagnant population is the biggest problem for the financial sector in the next few years, because this sector is premised on constant growth. And if that growth can't be achieved by the usual means, financial companies will be strongly tempted to maintain growth by accepting more risk. This is most easily apparent in the credit card business, where banks have been willing to accept high write-offs and delinquencies in order to keep growing, but it's also present in assets like homes and office buildings, whose value is based on future demand that very likely will not happen. With that introduction, let's look at the job growth in the financial sector. Here's a picture of job growth over the last few years. There's been a striking loss of finance jobs this year. Bankers have steadily been cutting jobs. It's difficult to know if this is because of cost cutting to maintain profits or if computer technology is just getting better at doing banking, most recently with artificial intelligence. The job situation is quite different at credit unions, which have been adding staff at a high rate. The business of credit unions is local and highly personal. Car loans, small business loans, home equity loans. Jobs are also growing at a high rate in portfolio management, where operations are already highly computerized, but personal interaction with customers is necessary to acquire and retain their business. Insurance companies, on the other hand, are mainly concerned with computerized risk management. The sharp loss of jobs in the past year may signal the need for cost cutting or just strong implementation of artificial intelligence to manage that risk. The parallel situation with insurance agents suggests that cost cutting may be the larger force. This is entirely a personal business where you would only cut jobs if there are fewer clients coming through the door. Artificial intelligence isn't much use to companies that rent out office space, apartments, and homes. It's very likely that the slowing of the US economy and the high cost of housing have just reduced demand. The job volatility in car and truck leasing makes explanations difficult, but the importance of trucking in moving goods across the country is one possibility. And the surge in the building of data centers is a strong possibility for leasing of construction machinery this year. So here's a summary of the job situation in the financial sector. The largest numbers of jobs are in commercial banking and insurance, and these jobs are being cut. Credit unions, portfolio managers, and machinery leasing operations are adding jobs. Overall, the financial sector seems to be less optimistic about the future. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of developments that affect the fortunes of their customers. Vertical IQ provides the data and analysis they need with detailed industry profiles in 330 metropolitan markets. Thanks very much for following along. This is our monthly industry focus. I'm Ingo Winzer.